So good afternoon to everyone as our participants start to file in. Uh, this webinar is titled PCbCR, or Public Country by Country Reporting in Practice, a Landmark Year for Tax Transparency. I am today's host. I am Greg Yates, the Senior Ratings Manager from the Fair Tax Foundation. And broadly, I will be leading off with a summary of the study that Fair Tax Foundation has been putting together on earliest European public tax transparency reports. And then I'm going to invite in two expert speakers to give their perspectives. So I will start now by sharing my slides. So hopefully everyone can see this okay. So just a note about the Fair Tax Foundation. Because not everyone will know exactly who we are an organisation that recognises and celebrates responsible corporate tax conduct. And we do this primarily through our certification scheme, the Fair Tax Mark label. This is similar to the Fair Trade label and what that does for ethical sourcing, but we are certifying and recognising a business's responsible tax conduct. So we now have about 275 businesses around the world that carry our Fair Tax Mark label, and those include the likes of Repsol and Amadeus IT Group in Spain, Fortum in Finland, and Ørsted in Denmark, so now certifying businesses all around the world. We also have a new product that we can offer to businesses that we operate with our partner CSR Europe. This is the Tax Responsibility and Transparency Index. It's a benchmarking tool which can be used confidentially or publicly by multinational businesses to better understand their corporate tax conduct. It's different to the Fair Tax Mark. It can be used strictly internally as a way for businesses to work out and understand what they are doing well and how they can improve. And to date, 21 large multinationals headquartered in 10 countries have undertaken benchmarking. Just a quick note that this week is our Fair Tax Week, so we're celebrating good tax conduct and our Fair Tax Mark businesses all week long. We've got another event on Thursday, the 25th of June, which is celebrating the launch of our new National Business Standard, being hosted by my colleagues Jamie Boswell and Natasha Turner. And this is exciting news for us. If you want to hear about how national or domestic only businesses can be certified all around the world with our Fair Tax Mark label, you can register for free through our website, and we'll drop a link in the chat at the end of this webinar. So today we're here to talk about public country by country reporting. For multinational businesses going through our Fair Tax Mark certifications, public country by country reporting features prominently in our assessment standards. One of our key asks is that businesses should pay the right amount of tax in the right place and at the right time, while providing stakeholders with public information about their financial presence and impact across the globe. And for the world's largest businesses, we at Fair Tax Foundation believe that the way to do this practically is through public country by country reporting. I'm here to share Fair Tax Foundation's latest research about European tax transparency reports complying with the EU's public country by country reporting directive. And I'm joined today by two expert speakers who will be providing us with their viewpoints about both public country by country reporting and tax transparency developments around the world. So firstly, I have with me Reijo Salo, the Vice President of Corporate Tax at Fortum, a Finnish energy business which generates and sells electricity and heat, providing its customers in the Nordic system with a supply of reliable energy. Fortum are a Fair Tax Mark certified business, and they publish an excellent tax footprint report each year, which is well worth a read, which includes voluntary public country by country reporting data, if I could praise Reijo and his team. Prior to his current role, Reijo was also Fortum's longtime head of tax, and he focuses on strategic planning, tax policies, tax governance, and tax transparency. A special thank you to Reijo today because he's joining us during a personal holiday. And for a US and global perspective, I've got with me Zorka Milin, who is the policy director at FAT Coalition. FAT Coalition is a non-partisan alliance of more than 100 organizations whose mission is to promote policies to combat illicit finance and campaign for a fair international tax system. Zorka leads on international tax policy and other transparency priorities, and she's kindly joining us today from Washington, D.C. So thank you, Zorka. Before joining FAT, she served as senior advisor at investigative watchdog Global Witness for almost 10 years. She's also taught at Georgetown and Yale universities and practiced international tax law for more than 6 years with two leading global law firms. So thank you to Reijo and Zorka. I'll move on now to explain our research findings. So the EU PCbCR directive requires large multinationals that have a substantial presence in Europe to publicly share key financial information about their operations across the EU and in a designated list of non-cooperative jurisdictions. The general timeline for this reporting for European multinationals is for financial years ending in 2025. Most businesses will then report data 12 months later in 2026. So later this year, we'll see a lot of tax transparency reports from European businesses. This study that we have done at Fair Tax Foundation looks only at reports that explicitly meet the EU PCbCR standard, and we've rated them to how good and how complete we think the disclosures are. This is not a review of voluntary reporting, so we've not included voluntary reporters in this. It's specifically looking at businesses that are claiming their reports to be complying with the EU's new rules. A bit of background. Our initial analysis was shaped heavily by Romania, that had a requirement that reports were filed a lot earlier than the rest of Europe. Since then, reports have started to emerge because of Croatia's law, which had also had an earlier filing deadline. Reports are now emerging in Spain, which requires reports to be filed within 6 months of balance sheet dates, which is shorter than the 12 months across the rest of Europe. A second annual wave of reporting has come through in Romania for year ended 31st of December 2024. And first reports are now starting to appear that meet local laws in the likes of Ireland, Denmark, Hungary, Belgium, Finland, Sweden, and Germany we've picked up. A significant majority of the reports reviewed so far relate to multinationals headquartered outside the EU, so some important context about that. EU groups can generally follow the reporting timeline of their home member state, so a German multinational only needs to report when the law requires in Germany, which should be late 2026. But for a UK business or UK multinational, for example, with a Romanian subsidiary, they would have to look at local law everywhere where they operate and have a significant presence. And so UK, US multinationals, for example, have been drawn into complying with Romania's directive early. What does the data set look like that we've put together? Well, we've now rated 302 multinationals and their approaches. We've also examined 66 second-year reports from businesses already within that wider population. And to our knowledge, this is the most wide-ranging analysis published globally to date. A link to our latest update will be available in the webinar chat, so you can visit our website and see all these numbers written down. So what we found as a headline compliance rating. This table is showing the 302 businesses, and we're breaking down their reporting on a traffic light type system where poor is in red, what we rate to be poor. Partly implemented reports we have as yellow or amber, and good or great reports we show to be green. So we have 58% of qualifying multinationals meeting the PCbCR directive requirements solidly and being good or great. For us, that means good means they've done everything that directive asks for, but exactly that and no more. Great means that these businesses have gone above and beyond and really tried to embrace the spirit of the directive by disclosing more jurisdictions, disaggregating more jurisdictions, and perhaps disclosing data worldwide and more data points. So they might have gone beyond what the directive requires itself in terms of data points. For the poor reporters, we either see them making little or no effort at all. So a report has been put in the public domain, but there's no financial information in there at all. Secondly, they might disclose data about just a single country. So a business meeting the Romanian law might put out a report that shows data for Romania only and no other jurisdictions. And thirdly, we see some businesses doing that, but extending it to also include data about the EU's list of non-cooperative jurisdictions or tax havens, if you will. So 39% of multinationals, which is quite interesting, a significant minority make attempts that we currently classify as poor. Interestingly, we're seeing different reasons why the data isn't being disclosed. We're seeing some businesses quote the safeguard clause and playing the commercial confidentiality card not to disclose information. We're seeing some businesses say that their parent entity won't provide them with data. So the reporting subsidiaries in Romania and Croatia, for example, say they cannot get group-wide information. So they've had to report information about Romania or Croatia only. That's the headline findings. If I move on. So the bulk of reports we've seen comply with Romania's local law. However, we're also seeing EU member state laws kick in across the European Union. So we've seen 50 reports spurred by Spain's law, 30 complying with Croatia's law, roughly 10 meeting Hungary's requirements, and we've seen 3 now filed in Ireland, which I will come and explain to a bit more about in a subsequent slide. Interestingly, in Romania, we've found 66 second cycle publications, and almost none of these show a noticeable improvement over year one. There is a bit of nuance here because about half of those first year reports were already rated good or great, so there wasn't much room for improvement. But among those multinationals that rated poorly in year one, few seem to have used that second cycle of reporting to make incremental progress and improve their disclosures after grappling with the initial data gathering and reporting requirements. An important slide to look at now, which breaks down our findings of the 302 reporting businesses by the country from where parent entities are being forced to comply. So we can see from the table that over nearly 40% of the businesses, 120 of the 302, have headquarters or ultimate parent entities in the United States. The United Kingdom, Switzerland, and Japan have also been disproportionately affected, so they're about 10% each of the population. Spain is gathering pace, where the early filing deadline is kicking in, and many businesses are reporting in June 2026. And then all other countries we can see make up a much smaller part of the population, 33 countries and 85 different businesses. It's interesting to note that UK and Japan headquartered multinationals seem to be doing a better job of the reporting. We rate 78% and 69% of the reports we've seen as good or great from those countries. So there seems to be a national and cultural difference in the way businesses are responding. US and Swiss businesses, we are seeing poorer attempts at the reporting. So only 41% from US businesses and 46% of businesses good or better. This isn't to say that we're not seeing some reports, good reports from the United States. If I could call out the likes of Molson Coors, Ford Motor Company, Cisco, and Adobe, we've seen some excellent reports from those businesses. So it's merely presenting here what the findings we found are, not singling out US businesses for criticism. Really worth looking for those businesses' reports that I've just mentioned. Some national examples, if I could just give them. Interesting anecdotes. In Croatia, not all of the reports are hosted on businesses' websites. So FINA, the central hub that's associated with the Croatian government, has a hub where you can go and look for the reports. And many of the businesses we've seen that need to report in Croatia referencing the online hub, and you can go and see the report there instead of on a business website. We actually found that many of these reports weren't being published, and we've had correspondence with FINA and prompted them to publish some of these reports, which was quite interesting. And now the system seems to be operating a little more efficiently, but worth looking at Croatia's hub. In Spain, numerous reports are single country entries featuring data for Spain only, but these often promise more soon when timings are better aligned. So we have businesses needing to report in Spain, but saying that a 6-month filing deadline is too short a time for them to gather all the information, and that they will come back and file and publish an updated report with all the information in it at a later date. So interesting to note that with Spain. In Ireland, we've detected a well-crafted first report prepared by a UK multinational Smiths Group PLC ahead of required filing deadlines. And we've now seen 2 further reports appear online. There is an online reporting document library accessible through Ireland's Companies Registration Office, and I'd encourage you to go and have a look at that. We've corresponded with the Companies Registration Office, and they have confirmed that reports are being made public as they are received. And if I just show that there on screen, you can see the screenshot. If you follow in the top right, if you click in the top bar on forms, and then in the left-hand bar, country by country reporting document library, you can go and have a look at those reports. It's quite interesting to see the 3 that have been filed publicly in Ireland. Another point we've noted that's quite interesting, and perhaps lawmakers might not have been anticipating, we're seeing some multinationals file reports that comply with laws in multiple jurisdictions. So we've seen 2 multinationals prepare reports meeting Croatia and Romania's requirements in 2025, which we rate as good or great in both instances, which is really good. But we see other multinationals taking a very fragmented approach instead of disclosing consolidated group-wide information. So a small number of groups present returns for both Romania and Croatia, but they show only Romania as a single country and only Croatia as a single country in the 2 reports. And a few businesses have done the same for both Romania and Spain. So it seems interesting that a business might take that approach, maybe file 27 different reports in the different member states. I'm not sure whether lawmakers were anticipating that and what will happen in future, but just interesting to note that we've seen that from a small number or a small part of our sample. Just some findings here by industry and sector, which I think are less significant than the country where businesses are headquartered, but still all the same. Multinationals in the technology and industrial sectors contribute about a third of the reports we've found, 97 of the businesses in total. The majority of industrials and manufacturing sector multinationals are complying with the directive well. Both of those sectors showing over 65% or better of the reports we rank as being good or great. Interestingly, the red highlighting you can see there is the automotive, pharmaceuticals, and healthcare sectors who are doing worse. So only 30%, 40%, and 41% respectively reporting in a way we would consider good or great. Maybe the healthcare and pharmaceutical sectors align somewhat with the US and Swiss headquartered businesses and their reporting not being so good, but automotive is interesting, which I thought may have aligned more with the manufacturing sector, but not so far. Only 3 out of 10 reports we've seen being good or great for the automotive sector. So if I could just set the scene then for the rest of the webinar and my external speakers, my external guests. What comes next now in 2026 and beyond in terms of both the EU PCbCR directive and global developments? So the EU directive will really take hold as 2026 progresses, as many in-scope multinationals publish data for the first time. Some multinationals may display documents on their websites, while others will file information with disparate national business registers. On comparable compliance timelines, we've got Australia introducing a public country-by-country reporting law, which is similar to the EU's. It complements it, but builds on it in many ways. It's well worth a look at the requirements. It's very, very good what's happening in Australia. There's a list of 49 specified jurisdictions for which to disaggregate data if they have a significant presence in Australia, including the likes of Switzerland and Hong Kong. In the United States, we've also got a financial reporting standard update. So the Financial Accounting Standards Board has updated the US GAAP accounting requirements around income tax disclosures, demanding enhanced breakdowns in terms of country-by-country income tax payments and country-specific factors affecting tax rate reconciliations. And we'll see that data appearing in Form 10Ks and the financial statements prepared by listed businesses in the US. Australia's law asks parent companies of its qualifying multinationals to submit their reports to the Australian Tax Office, where there'll be a central repository of data. That will be opening probably later in 2026 is recent news. It was anticipated it would be in the summer, first of all, but might be a slight delay. But it's interesting for Europe to note, because I think one of the things that our research has highlighted is that these reports in Europe complying with the EU directive are very difficult to find. It involves search terms in different languages through search engines. It's not, you can't go to one place and find the reports. There's no uniform requirement. Australia will have that, so it will be interesting to see how that pans out and how Europe can learn from it. The big point to note, perhaps for later in the webinar, is that some large global multinationals listed in the US are going to need to comply with all 3 new tax transparency rules in 2026. So 3 different requirements, 3 different sets of tax transparency data that haven't been in the public domain before, and they will all be released in 2026. So that deals with my part of the presentation of our data and findings. If now I could introduce Reijo into the conversation. Reijo, you work with this kind of data, and you have been doing for the past decade or so. Fortum has been reporting about country-by-country taxes for over a decade. What are the challenges associated with doing this? And was it hard to publish such disclosures for the first time? Does it get easier as time goes on? And what can businesses learn from your experience?
Yeah, thank you. I'll just give a few words first about why did we in the first place beginning to report, and whether then come to the question whether it was easy or not. So that it was somewhere around 2007. I was discussing and listening to discussion, and it was obvious to me that tax will be the next topic for discussion, for public discussion. And we were, with my team, we were wondering that, how would we create understanding of taxes? And we noticed that we actually are talking quite little about taxes. So step by step, we started to increase the data on taxes, like the reconciliation of effective tax rate. And then we, somewhere around 2010, we were ready for the first time actually to publish a public country-by-country report on total taxes, not just income taxes. The C4 we had at that point of time was a bit I would say perhaps conservative, so he didn't accept the idea us actually publishing the report. We got a new CFO who is actually our CEO now currently, and he was okay to actually us starting to talk about total tax contribution, and we thought that we wanted to create understanding of our tax contribution, and we soon noticed that just publishing numbers and some kind of KPIs is not going to be enough, that we also need to open up our tax principles. What are the principles that we actually are following? And we had to learn, reflect those principles within our own work to get there. That means we are actually doing things as we are saying that we are doing, and not only the tax people, but also the business people. That surely was a challenge. Now then, there were on the road, there have been multiple challenges, and maybe this is a little bit long list, but I will go through my list anyway. So first of all, I think the KPIs, they've been always difficult. In tax is a consequence of business. And then what KPI would actually illustrate our tax payments in relation to the business well? And we learned that it's hard to find actually one KPI, because we are an asset intensive business, capital intensive business. So the number of employees not very very valid for us. Turnovers neither, except for our consumer business, where the net sales is a driver. So we learned that we most likely would need to use multiple KPIs to actually reflect, but it took a long time and to get there. Then another challenge is that taxes actually are quite complicated. We need to follow and understand multiple standards. When working within a business, we need to understand the business reporting. When they report, they totally ignore taxes, they totally ignore companies, and they totally ignore also countries, because they are working with their business unit. And out of that business, we need to, of course, first of all, report taxes based on IFRS, which is a forward-looking standard, where how do we see that taxes will be, and how the bookings income is recognized based on the future view. And then the other aspect is the cash tax, which is quite often based on the backward looking. We look backwards, what has actually happened, and what taxes should we pay based on that one. So combining those two different or three different approaches is pretty complex. And if you want to talk about and communicate something about that, it becomes even more complex. Then I think we've seen sometimes when we've been reporting that numbers don't change at all between years, that they look alike, but actually there are a lot of events. They are just offsetting each other, meaning that when the sort of exceptional events they are out, then the numbers will jump whatever up or down dramatically, and that was really a key for us when we're reporting, that we need to understand the business and the consequence. So that even in case where there is no visible impact, we would understand what has happened, because the impact or the sort of exceptional change might come later on, and then you need to go back and understand what has happened. Then one thing that is mentally very difficult, that you actually when we are working with the report, we are deep insiders. We know we've been working on the numbers, and we've been working with the business. We've been looking at what kind of solutions there should be, and what is the tax treatment, what kind of discussions we have with the tax authorities. So we know it in and out. But the publicity or those stakeholders that we are talking to, they know absolutely nothing about that. So it's really difficult to actually take out yourself from an insider view and try to explain it to an sort of external stakeholder, and external stakeholders might even be group internal stakeholders, that they would understand what we are actually talking about. What does this mean? As a good example for us was the 2022 events, when we sort of were in a crisis mode with Uniper, and also the sort of Ukrainian war created all sort of challenges. I think we had 3 or 4 really material challenges, putting us in a sort of crisis mode not just with one topic, but multiple topics. And they all had, of course, different kind of impacts. And then we knew them, but when we discussed with tax authorities about the impacts, we could see that they didn't understand at all. So that's really a difficult thing also to approach and think how that is illustrated in the numbers and what should you talk about that. The KPIs I've already said something about. And then perhaps from the sort of being an insider is also the different expectations of different stakeholders. Investors have totally different expectations than perhaps tax authorities, and tax authorities in itself. They, of course, we discuss a lot with them. We report tax returns, all that to the tax authorities, and they get more technical data and information than anyone else. Employees, very important stakeholder for us. Policymakers, also civil societies, of course, are important, but all of them have a bit of different kind of agenda and also different kind of need, although we talk about the same, at least with the same name about these topics. So that has been difficult to sort of recognize and also choose who we want to satisfy, because you can't get everyone to be happy. And of course, it's okay to also disagree on the things we actually been doing. So, and the last point on the challenges, perhaps that maybe the amount of details is also, it's a tremendous challenge for us. Maybe I can go on with the sort of what kind of we've learned.
We can. I was going to ask you to speak to narrative. That we at Fair Tax Foundation believe that narrative is crucial to explain country by country reporting data. And I think the answer you gave demonstrated how a business has to grapple internally with making these kind of disclosures. And it maybe the shock of a law forcing you to do it can be difficult, because it seemed like it was a long process with Fortum. But notably, there isn't a requirement explicitly to explain the data published in accordance with the EU's directive. There's no law to do that. But can you talk about Fortum's approach to providing narrative and how you decide when to add context? And if you're aiming the report at a broad set of stakeholders, as you've spoken about, how do you decide when and where to add context, and how much is too much, for example?
Oh, good question. I should say next one, please, but I'll try to answer. We came to the conclusion, we started the reporting of total tax contribution in 2012, and I think the couple of first years we were reporting happily. Then we started to recognize that, hey, we have ourselves, we have problems. What would be the sort of way to get more flesh on the bone on the numbers? And we came to the conclusion that we need to open with narratives, that we get a lot of numbers, but if you're not a number person, how can you read the numbers? And numbers also, some people understand more of them, some less. So that's where we came to the sort of idea of having narratives, that we explain what we actually illustrate in number form. We would explain in words, and that developed on so that we wanted to actually explain not only our tax principles or the value chain, but we would also explain per country what has happened in a specific country. And if we have more important countries than others, then we would make a little bit longer narrative where we explain all the income taxes, what has happened when you compare 2 years or 3 years with each other. Why has the amount of taxes been changed? Is it because of power price in our case, or is it because of something else? Also the VAT, it's quite an interesting sort of you can see how mergers and acquisitions impact that one, investments, that we explained why they look like they look and what has happened between the years, which actually is very helpful also for managing the taxes to understand what it means. And then later, for the 2022, which I mentioned on Uniper, that was really a drastic year, we came to the conclusion that we can't explain it at all. So we need to make questions. So we made questions and answers, hoping that those who are interested could find the question that would illustrate the answer. So that we've tried multiple ways. And I think it has been a good way, both internally and I think also externally. I at least hope that our stakeholders would understand what it means and what kind of tax consequences and what kind of tax footprint we actually do have.
Really interesting. Thank you. Yeah. Particularly when it is an extraordinary event, so to speak, it seems really important to be explaining what's going on so that the data isn't misinterpreted and you don't have someone else telling the business's story for you. Could I ask, Fortum goes a step further than the EU PCbCR directive by publishing more data voluntarily, including total tax contribution information about taxes collected and taxes paid, as you said, as well as data about all the jurisdictions Fortum operates in, so you don't aggregate any data in that regard. What do you see the benefits of doing that voluntarily going further?
Yeah, sometimes we might see benefits, sometimes maybe less of benefits. When we started, we first had only the material countries, and then there were many stakeholders where they sort of saying that we are hiding something, and we were wondering that, well, if the countries that we don't list, they represent like less than 1% of everything of us, so it doesn't sort of, we are not hiding, but obviously they thought that as we don't present, there's something that we hide, and that's why that's when we, and maybe when we saw that the public country by country report is coming, we thought that we'll just release everything because then we basically we have nothing to hide, and if there's something that is odd, then we'll explain that, and that was, I think, meant for those stakeholders that actually were interested about that we would open it up. The downside of that one is, of course, that sometimes very small details are driving some discussions, but if you if you think your narratives properly enough, then you have answered the at least the most important questions already when we publish the tax report. And I think that's one important part, of course, is to sort of give the answers to those stakeholders, and that's what we're trying to do also in the tax footprint. We represent, we have a list guidance for the readers that which, if you are certain stakeholder, which sections we do think serve your purposes more. And I think that is the benefit, that you actually can go and read more about those things that you are more interested about, and you can manage the details, because there are a lot of details within the data.
It's really interesting on the perspectives that you speak about there, and I know as a reader of Fortum's tax transparency report, I think you have an excellent balance between narrative and there not being too much detail there to blind stakeholders. It's really interesting. So thank you, Reijo. If I now introduce or bring Zorka into the conversation, Zorka is going to provide us with an important US perspective and a global perspective. It's tempting to think that this is an EU directive. The reports are appearing to comply with European laws, but really the greatest number of large multinationals affected by the new laws in Australia and the EU are headquartered in the United States, as Fair Tax Foundation's findings show. And the new Financial Accounting Standards Board disclosures are kicking in on the same timeline in the United States and complementing the pure PCbCR data disclosures we're seeing in Australia and Europe in 2026. So, Zorka, if I hand over to you, I know you have some slides to talk about your perspective.
Thank you so much, Greg, and Fair Tax Foundation. My name is Zorka Milin, and I am with FACT, which, we love FACT, but it stands for Financial Accountability and Corporate Transparency. And as Greg said, we are a large coalition, more than 100 member organizations. Some of them are here. We're US based across many different issue areas, across many different sectors. Our members include labor, small business organizations, as well as civil society groups focusing on anti-corruption, environmental and climate issues. And all of those groups are united around goals of a more fair and transparent US tax system. We've been especially focused on taxes of big US multinationals, and that's been kind of a challenge because that's been a black box. So the findings that Greg presented in terms of the weak compliance of US multinationals with the European rules are not especially surprising, but still disappointing. We have seen, when it comes to voluntary public CbCR, we have only seen 2 public US multinationals that have ever voluntarily published CbCR reports. And when it comes to mandatory regimes, things don't look that great. Not only the EU, but also the new US accounting standards, which I will talk more about later. Many companies have been very opposed and have pushed hard to weaken the standard. And then on the Australian country by country reporting, US corporations have been quite active, lobbying to delay and weaken the regime. What I'm showing in this slide is a letter from a few months ago that was led by the U.S. Chamber of Commerce. So that's all been unfortunate. But now we are in a year that is, as I think Greg said, and I completely agree, is a real watershed year when it comes to corporate tax transparency. We see all of these different regimes coming online that affect U.S. multinationals, the EU directive, the FASB rules, which I'll talk about later, and the Australian reports. This is kind of captured in a really great headline from Wall Street Journal. We are starting to see corporate America finally revealing, maybe not all, but at least some of their tax secrets. So FASB, what is FASB? For those of you that are not US based, it is sort of the US equivalent to IASB. It stands for Financial Accounting Standards Board. It's an independent body. And they have improved the previous accounting standards that were in place when it comes to what companies are required to say about their taxes. And I've highlighted here three particular aspects of those improvements that are especially important. There's new information when it comes to tax rate reconciliation. We're seeing more information about cash taxes paid. And last but not least, major tax effects that are above. So the threshold is set at 5% of the statutory corporate rate, which for US-based multinational is 21%. So if you do the math, that comes to 1.05%. What I want to emphasize is that the FASB push was not a civil society campaign. It was really led by investors, and FASB was responsive to investors' demands. So here's a quote from FASB chair that kind of illustrates that. I think this is especially important because sometimes these tax transparency rules get kind of dismissed as not really being material, but that's clearly not the case. So the FASB rules did not change overnight. It took a decade. I was looking back through the files, and I think the earliest instance I found was from 2015 when FASB first put this issue on its agenda as something to work on. And then there was press attention, press coverage from 2019. Here is an example from the Financial Times. And over the years, we have crunched the numbers and we found, again, significant investor support. Investors representing 10 trillions in assets under management have supported greater tax transparency in some form, whether it's with FASB or in terms of expressing their report for public CbCR in various ways. So what is FASB? And how does it differ from the CbCR? So this is kind of at a glance comparison, really high level. As Greg said, FASB is not exactly CbCR, but it is complementary. So when it comes to ETR information, in the CbCR report, you would see jurisdiction-specific ETRs, but for FASB, there is more granular information on effective tax rates reconciled against the headquarters statutory rate. Again, in the case of US multinationals, that would be 21%. And then when it comes to kind of like different items that are required to be disclosed, while CbCR includes information on employees or tangible assets, et cetera, some of the things that Reijo talked about, what we see in FASB is more information on certain anti-abuse measures, including impacts from Pillar 2 and GILTI, which have been very interesting to observe and compare. And then the scope of jurisdictions, this is another kind of important difference, whereas those who are familiar with CbCR will have seen that both the EU and the Australia regimes have specified lists of jurisdictions that are limited. So neither of those is, comprehensive and worldwide in its scope. But for each of the listed jurisdictions, you have to disclose no matter what the amounts are. Whereas Under the FASB standard, it's kind of the other way around. There's no list of jurisdictions, but if the numbers are significant enough and if they meet the materiality thresholds, then you have to report. We and many others have been hard at work analyzing these new disclosures and poring over the 10K footnotes. This is a screenshot of our analysis where we looked at 40 major American multinationals and some of the tax effects that they disclosed. And we found really significant tax effects reported in low tax jurisdictions in last year, which is an interesting finding given where kind of international tax policy discussions are at the moment. And we've also been looking at kind of what are some of the oil and gas impacts, and our member organization ITEP has also looked into that as well. There's also been substantial press interest, and I will say not only from the tax industry press, like Tax Notes and Bloomberg Note Tax. We love you if you're on this call. But they've been kind of following the process, the FASB process, every step of the way, sort of blow by blow. Now we are seeing some of the mainstream press really showing interest in what the data is saying. So one of the findings in our analysis was that the tax haven effects were especially large for American companies in the pharma sector. So I thought that was really interesting also that Greg noted, that they were also, particularly bad at complying with the EU rules. Maybe that's not a coincidence. So this aspect of our analysis was highlighted in the Financial Times. We've also had New York Times shown interest in these disclosures, and they did a kind of pretty splashy analysis using AI and looking at all of the companies that have reported, not just the biggest ones like we did. So that came out, I think, a few weeks ago and was quite high profile. And then Wall Street Journal has been doing a really great job highlighting some of the specific companies. And as I said, I think this is a pretty great headline that captures well where we are in the US. I wanted to also say a few words about the situation in Australia, which we have been following with great interest, not only because it will affect a lot of American multinationals, but also given the strong opposition from the US business lobby. We have been weighing in several times throughout the process. We have submitted formal comments with the Australian Parliament, Australian Treasury, and overall, we think that the Australian standards is really kind of the gold standard now. It matches quite closely the Global Reporting Initiative. So we're really happy to see that and look forward to analyzing the information when it is publicly available later this year. So that said, as Greg said, I really kind of want to underscore there are all of these like multiple standards, which those of us that are looking at the information, are maybe not best served by, nor are the companies. So we do see some opportunities coming up that I wanted to kind of highlight where things can maybe improve, and there is certainly room for improvements when it comes to the EU CBCR directive. They will be doing a formal review next year, so we hope they will take on board, look at some of the ways that how Australia has approached these issues, and even in Australia itself, the list of jurisdictions that are in scope can be improved. We were disappointed to see that Puerto Rico was not covered, even though it is a territory of the United States for tax purposes. It is treated as independent, and it is, a favorite tax haven of many American multinationals. So that would be really useful and material information, as would information pertaining to the headquarters jurisdiction. Last but not least, we also believe that what would serve both U.S. companies and U.S. investors best is to have SEC step in and really, publish a rule that would mandate a CBCR here in the U.S. So we have organized a petition from investors. A couple of years ago, we submitted a petition to the SEC that calls on the agency to do just that. And it was supported again with a significant number of investors representing trillions in assets under management. We also have proposed legislation that has been introduced in Congress in both the House and the Senate for going back many years, which would require the SEC to do just this. So right now the SEC has the authority to do it, but they haven't kind of acted on it, and Congress can require them to do that. The legislation actually did pass in the House in 2021, but not in the Senate. So that's also definitely something to watch. And I'll stop there. And yes, happy to continue the discussion.
Thank you very much, Zorka. So, thank you very much. And if any of the attendees want to ask questions in the chat, please feel free. I have some questions to start us off for Zorka and Reijo to carry the conversation on. But if anyone has any questions that they'd like to introduce in the chat, please do feel free to drop those in. Reijo, if I could ask you, first of all, just something that I had thought about while I was listening to you and Zorka. As a reporter like you do voluntarily of public country-by-country reporting information, do you have a plan to comply with the EU's directive legally, for example? Will you publish a separate report, or is what you already publish enough to deal with that side of things?
We've thought, first of all, the deadline for us to publish the country-by-country report, public country-by-country report, is sort of a lot later than when we are publishing our tax footprint, which is connected to the annual report, when we publish the annual report. And we are sort of, we are considering how much more we should or we could do, and whether it brings any more information on the table. Means some parts of the, when you go further, it maybe it's more correlating to transfer pricing rules, and if you don't have the transfer pricing documentation, then it's difficult to make anything out of that. And that's the main sort of driver for us, that it would be something that is readable and understandable, not only for us but for others, and that might be driving. We are every year we are trying to make an improvement, and let's see where we go. We have some ideas what to do, but let's see how we can manage with that one. But sort of just bluntly publish like the EU country-by-country report is a topic that we need to think whether it's, is there any value, or is just more work? And we are always a little bit stressed with the resources, so you need to balance and think what is the contribution.
Completely understandable. So it sounds like there won't be one correct way to do it necessarily, and that you are still understanding the best way to do that. Thank you. Zorka, if I could ask you, my findings, or our findings here at Fair Tax Foundation, I think you touched upon it in your presentation early on. A significant number of the US multinationals are being captured. But do our findings that reflect a poorer rating in terms of what we're seeing for compliance from the US multinationals, is that reflective of a cultural difference between North American and European businesses, and how they will look at these new corporate tax transparency rules?
Great question. Yes, I would say I think that there is a bit of a cultural difference in terms of how companies are approaching tax transparency, and it's hard to kind of explain what the reasons are for that difference. But I guess one thing I would note is that the ideas around sustainability reporting and ESG reporting, which seem very broadly accepted, supported in Europe, have had a more complicated and polarized reception here in the US. So I think that that's a part of the story. Then, I guess there is another explanation that is maybe somewhat cynical, but what are the US companies hiding? Why are they so eager to, or why are they so reluctant to come clean? And here, that's just to illustrate that, I was quite struck with your finding that in terms of the sectors that are not doing great under the EU CbCR directive, that pharma was one of the sectors, and as I noted, that was also the sector that we found is quite fond of using tax havens. So I think that may also have something to do with it, that American multinationals, not all, but some or many of them, simply have tax practices that they would prefer to keep hidden. And I also think that that plays a role in sort of why we are seeing so much interest, public interest, press interest in these disclosures, precisely because the companies have been so opposed. And then, I think as a tax journalist, you might wonder, well, why are they opposed? What is it that they are trying to hide? Is there a story there? And as it turns out, there are some interesting stories to be uncovered, both in the sense of finding general patterns, but also seeing this information about specific issuers, specific companies for the first time. I think it's been quite quite a gold mine for tax reporters and for groups like ours that are analyzing the information. So yeah, I think it has something to do with American companies are maybe just not as responsible, frankly, when it comes to their taxes, unfortunately.
Really interesting. Thank you very much. Really interesting. We've had a question come in from the audience, which is about the EU directive and the role of external auditors and the existence check by the external auditor, and what's our experience been with this. Reijo, you might be better practically in a position to talk about what the auditor discussion might be in terms of you publishing the report or not. But I think anecdotally, I think we've spoken to a multinational that said their auditor was grappling with what to do and was interested in the amount they would disclose and wasn't just going to issue a statement okaying everything. They wanted to know more about what was being done and a sort of a minimum level that they would expect in terms of disclosure. I don't know if you've had any conversation with your auditor about it, Reijo, or you professional advisors.
Oh, we've had a lot of discussions because we thought first that we would have a kind of a light audit on our report, which is complex because there is, the standard like IFRS is a clear standard that you are auditing against something. And with the public country report, you sort of have a product, but you don't have the standard necessarily. Then you end up being audited through processes. And we've been discussing things like how should the audit statement look like? Is the full audit, which is extremely expensive, of course, and when we stressed with the budget. So we've done our main auditors who have reported and audited all our numbers. They've then reviewed also our tax principles. They've audited the process, how we gather the information that we report country by country, and based on that one, then they've made a statement. But sort of whether it was easy, no. Whether it can be very expensive, it can be extremely expensive, or if you want to have it a bit on a sort of more simple level, then it's visible on your statement, in the audit statement. But it takes a long time to get there, to get a common understanding what should be audited and how it could be audited.
So you have an interesting dynamic between the directive, the report itself, the tax footprint report, and your annual financial statements as well. So it's really interesting. Thank you, Reijo.
Could I just add what Zorka was saying about the US companies? And I think there's a cultural difference, but very interesting. And I'm sure that there are secrets, but partly I think sometimes when you talk about tax secrets, part of that might be also the complexity. And knowing my colleagues, we are not really the communicators. So you sort of rather say nothing than you start to try to make something understandable out of taxes, which are complex, and we are used to talk to other tax people and we understand each other, maybe not anyone else. And I think that is a challenge to overcome that threshold. That if you explain what has happened and what is being responsible doesn't mean that you would maximize that. It means just to pay the correct tax. But it's a big threshold to get over. On top of there may someone might be hiding something, but I think that's sort of we should think about also the complexity here and how to make it easier for the companies to actually talk about it.
Really interesting, Reijo. Do you have a response, Zorka? I can take another question. I've got an interesting one come in.
Yeah, I would just say I think that's absolutely right. That the tax folks and I was on the private sector side earlier in my career, don't always speak the same language, and I think that there is a risk of definitely, I agree with that. But that said, I do think that there's something, U.S. specific that we don't see as much in Europe. So I think it's a both, and there's one culture gap between the tax people and kind of everyone else, and then there's also another one between US and Europe.
Really interesting, thank you. I've got a question coming in asking, Reijo, in your experience, what's your understanding of investor needs and expectations in terms of your reporting?
Sorry, could you repeat?
So in your experience, I know Zorka's talked about investors' role in pushing forward the FASB standards. What's your understanding of investor needs and expectations in terms of Fortum's reporting?
That's a good question. I've asked our investor relations, and there are some investors are a bit of interested in our tax report. Of course, we have our Finnish government is the main shareholder, so they are interested in it that we report. But I have been surprised how little questions we get. I mean, we get no questions at all. We put even a separate email address if anyone would have any questions that you could send the questions. Very little interest. Maybe, and I hope it is that we've done a proper report, that there's not much to ask. But the sort of concern I have is that I mean, a big majority of the investors aren't that interested in that one to actually that they would raise up questions. But we've been trying to be forerunners to actually publish the information. So I'm not sure whether we are the best ones, but I should answer this one.
Interesting though, but very interesting to hear the other side of the table sort of perspective on that. And maybe it's a reflection of your public reporting, Reijo, that doesn't leave many questions.
I don't know.
There to answer, but for Zorka, I've got a question come in that says, the FASB disclosures, are we seeing any impacts in the power of the tax authorities, the interest of the tax authorities in the US to go after multinationals now that they can see a bit more and more is being disclosed publicly?
I think that the FASB disclosures are really meant to serve investors and not the IRS. That said, though, I will say the IRS has been quite active in recent years in bringing and continuing to pursue large, very high stakes transfer pricing cases against a number of major American companies, including Coca-Cola, including Meta, Microsoft, and those are still pending and continuing. In fact, they're about to argue the appeal in the Coca-Cola case. So we have so far, at least for the time being, I think that the enforcement has continued, which has been encouraging to see.
Thank you very much. We're approaching the end. We've got plenty more questions. I'm not going to get through them all. So as a wrap up, I would like to say thank you to both Reijo and Zorka and the audience for joining me in Fair Tax Foundation this afternoon. Zorka, with the time difference, thank you so much. Reijo, for interrupting a holiday. Thank you very much, both of you, for joining us. It's been really insightful to hear from you. If you'd like to know more about what you've heard from me in Fair Tax Foundation, hopefully there should be a link available in the webinar chat to our websites. In terms of our database of EU PCbCR reports, we are sharing this with our Fair Tax Market certified businesses and multinationals engaging with us for a tax responsibility and transparency index assessment. For other stakeholders, please do get in touch and send an inquiry through our website or email me, and we can discuss how we might be able to grant you access. Thank you all very much for your time. I think it's been really insightful. The importance of this data in 2026 as a year for tax transparency. And the need, I think, as Reijo's spoken about, to follow the data with narrative and businesses to explain their own story, not rely on others to do it for them, has been really, really interesting. So thank you, everybody, and hopefully we can correspond and talk again soon.